So that will increase your profits by that amount and then the tax accordingly. So that's certainly a trap for many, many people. The other thing is when you're looking at a property to sell, obviously your real estate agent's fees, advertising, all those expenses obviously go towards reducing that capital gain. And at the end of the day, you calculate your profit, 10% tax, and then you reinvest that in whatever. So it can be a very good strategy. One of the areas that we see people miss out a lot is what I'll call a scrapping schedule. So particularly related to people who do renovations. So obviously when we do a renovation, call it a kitchen, you know, the quantity surveyor comes in at the end and puts a value against that new kitchen and gives you a depreciation schedule to write off the costs of that over time. What a lot of people miss out on is, what about all that stuff I threw away? The kitchens, the cupboards, the floor coverings, the sink, the taps. You can get a quantity surveyor to come in and put a value against all those things you're throwing away. I refer to it as selling my junk to the taxman. So the quantity surveyor would come in and put a value against all those items, add it all up, and in that year that you've done the renovation and thrown all those things out, you can actually get your full tax rate. So in super it would be 15%, but outside of super, if that was a property owned outside of super, you'd get an expense at your full marginal tax rate. So very critical to people who have done renovations or contemplating to make sure that they get that quantity surveyor to come in and do the scrapping schedule prior to the renovation, and then to come back in again at the end of the renovation to do a depreciation schedule. And what we're finding is even for very old properties, there is still significant thousands of dollars that can be attributed, to the scrapping schedule. The other thing in super is, what happens if it is an asset that I used in business? And we call that an active asset. So if I own that asset outside of super, like a lot of people do, commercial properties, business real property, in essence, assets that were not just passive in nature, there was a business associated with it, if I can give it that very short description. If you sell those assets outside of super, then you would get the normal capital gains tax discounts. You could also get what's called a small business concession. But the big one is any of those profits left over, you've got the opportunity to roll into super, and that amount of money would not be subject to tax. So that would reduce the tax on those active assets sold outside of super. There's limits on the amounts that you can roll in, and those limits are further complicated by the length of time those active assets have been held. So under 15 years or over 15 years. And the taxman also looks at the value of your other assets to determine what you can and can't reduce the tax on. So that's a fairly complicated topic, but please, if you've got assets, business associated type assets outside of super, there is a mechanism to reduce the tax by rolling some of those profits into super. So that's a very, very significant amount of money that can be spent. They call it the retirement concession, and I think that's one of the reasons a lot of people don't avail themselves of it. They fixate on the word retirement. It doesn't mean you have to stop work. It doesn't mean that you're now going to go and sit on the beach. It's you can you still get the benefit of that that relief. So really what the word retirement is more associated to you're retiring the use of that asset. So hopefully that helps a lot.